and welcome everyone. My name is Alexis Rogers and I'm the Customer Relationship Lead here at RightCapital. And I want to welcome you to our webinar today on to buy or not to buy and making informed asset purchase decisions. And this is always a vital topic that's going to be relevant across most clients' lives, is that evaluation that we do when we're looking at buying assets. And that can range from a wide variety of different types of assets, of course. So today we are going to be walking through, first and foremost, some of the different settings and assumptions that can impact certain goals and those certain asset purchases in the future, and how we can modify those settings if needed. We're also going to walk through a couple of different scenarios of purchasing assets. So some of those things that, everyone's going to be looking at, like car decisions and purchasing cars in the future, how we can model those types of asset purchases to business purchases and also property, primary home relocations, or purchases in general. So we're going to look at those major decisions that we will see across our lifetime. We're going to look at evaluating different comparisons of those scenarios and the different key visuals we can leverage to enhance those conversations surrounding that decision. That's going to be vital. And we're also, towards the end of the session, going to walk through all the different resources that you do have available to you when leveraging RightCapital. One of those resources being that during this webinar, if you have any questions, please feel free to use the Q&A section to type out your questions there. More than happy to answer any questions that you might have. Now, shifting gears into RightCapital, when we first log into RightCapital, we are brought to what is called our advisor dashboard. Now, if you haven't already done so, there's just going to be a couple things that I'm going to highlight with us right now that's going to walk through the first setting that's going to be prevalent that you can set as your standard at the advisor level. Now, what we're going to be highlighting is only going to be relevant for certain types of future asset purchases, but it also can impact other types of future goals, income, and a couple other things in the system as well. So in our advisor dashboard, when we navigate to the three dots in the upper right-hand corner, this is where we can access our assumptions, and more specifically, our inflation assumptions. So the reason why we're starting here is because this is where we set the global level standard for what we want to see for inflation figures, but also how we want to treat goals that we enter in the future, and if we want those to be inflated in between now and when that future goal occurs. So once again, going to three dots, assumptions, and under inflation, this is where we can set the standard for our inflation figures, whether it's general inflation, healthcare cost inflation, and a couple others. But what's relevant for today is our selection at the very bottom. You'll see it says for cash flow items in these selected categories below, if the start date is in the future, do we want to have those values inflated between today and 2024 and whenever those future entries occur? So whether it's an expense, a savings contribution, or income. Now, there are a couple things that I want to highlight for goals that are excluded from this treatment that are just unique entries in general. But right now I have it deselected, but if I select this and I indicate that I want my future goals to be inflated between now and when they occur, that's going to directly impact one of the goals that we're going to look at purchasing today, which is a car. So I'm just going to select that and hit save, but we can always come back and make the deselection or change this if we decide to change our preferences or assumptions in the future. Now you will see an info mark here that will detail what is excluded for these selections. Like I said, this is going to be relevant mostly for some of those minor goals, some of the unique entities that are not going to be inflated between now and today are things like pension income, annuity income, business income. That's all going to be dependent upon the actual data entry and the schedules that you're filling out as well. Same thing for goals. Some of those future asset purchases, specifically properties, and some of those lifestyle asset purchases are going to be excluded from this treatment. But the one thing that we are highlighting today is purchasing cars, which is going to be impacted by the specification. And I want to highlight that if you want to take the preference that you do not want any of the goals to be inflated between today and the future occurrence, all we can do is, instead of just maybe for an instance where we have a client plan where we want that specific car purchase goal to be inflated between today and the future goal, we would just enter that future dollar amount in that goal entry in the client plan. So if you wanted to have your global level standard, which is what we address in the advisor portal and what we specify from here, we can certainly have a different one here. And then in the specific client plan, if you just want that one specific client to have a more inflated goal, you can just input what you would expect that cost to be in considering your own inflation assumptions. So that's one thing I wanted to note, that we can certainly set one standard here. And then for a specific client case, if we know they're going to have a unique treatment, we can always address it as needed. But I just wanted to highlight that very quickly because that's going to be the first setting that is relevant for client plans in general. But now navigating back to our clients list, we're going to be opening up our client sample for today. So under our clients list, this is where we can access our existing client plans. Today, we're going to be looking at the Lorelei Gilmore family. And before we dive into creating proposed strategies and future asset purchases in general, I want to first highlight and address who we are planning for. So we're going to be navigating to the profile section and to Blueprint specifically. Blueprint is going to provide us this nice, easy to understand visualization of everything we have entered for the client's current plan. It also allows for us to make adjustments if needed, especially as we're entering 2025. If we needed to adjust anything, we certainly can. But starting with the Blueprint net worth visualization, we can see here that the clients are in their mid-50s, just about. They have 2 children, and they also have a current net worth of $3.1 million. Now, that does include some assets that I want to highlight. Of course, it also includes their debts, but they do currently have a primary home. We're going to be looking at a very common situation that they're evaluating, which is going to be relocating in the future and downsizing when they retire. So we are going to be modeling that specific scenario when we look at making our proposed strategies. One of the other things that we can walk through as well is proposing a different business asset purchase. So right now, Lorelei does own a business. I'm going to click into this entry real quick. Whenever we click on a Blueprint visualization or one of these cards, that's going to open up a drawer that allows for us to see and also modify the parameters for that entry. So for the business currently, she's got some nice distributions and also some actual W-2 salary that we're going to review in a second coming from this business. She owns this LLC, has a current valuation of $375,000. And currently it is set to be sold in 2028. There is a little bit of a cost of sale that we entered from here. And currently the situation is going to be a lump sum payment plan. So it's a one-time lump sum in 2028. But one of the things we are going to be evaluating is looking at that idea of purchasing a business in the future for Lorelei once she does sell this business. But that's the current state of their net worth. For their goals across their lifetime, they do have their children. One of them's already in college. The next one's going to be hitting college right as the other one leaves. So we're going to have that for a couple of years. They are going into a vacation next year and into 2026. And then we do have them retiring at age 67 respectively as well, with also, of course, long-term care kicking in later in life. For retirement monthly living expenses, they have a pretty nice goal. They're pretty avid savers and pretty avid spenders, so we're going to be capturing that for them as well. Now, under income, savings, and expenses, this is where we can see that nice kind of evaluation of what their current income stream is, fair amount. For Social Security, they are also going to be receiving or filing for Social Security at age 70, respectively, for both of them. So it's one thing we're going to keep in mind as we're looking at this. And then they are also pretty avid savers. They could be saving more if we wanted to propose that. And then they are obviously going to be avid spenders as well. So that's the current state of the Gilmore family plan. Now, what we're going to be evaluating is indicating some of the future asset purchases. But first and foremost, I want to highlight how we can implement future goals that are going to be occurring in the current plan. So one thing that we don't currently have entered is the car purchases that the family is going to be making in the future. It's not unusual for us to eventually need a car, whether it's in 10 years, 8 years, or however long it is. When that's the case and we wanted to capture that in the current plan, we can either accomplish that here under Profile Blueprint and under the Goals section here by just clicking on the Add dropdown. Or if we wanted to, and if we're more comfortable with the profile card layout, we can also accomplish that under Profile Goals. So both sections allow for us to accomplish the same thing. The data entry is going to be the same, and it still is going to have an impact in the plan either way. But when we're trying to enter in the current plan, that is accomplished in the profile section. So staying under Profile Blueprint, we're going to be capturing that car purchase goal because that is something we know is going to be part of the current plan, regardless of what happens in the future. So under goals, If we click on the add button, we can add a car purchase goal. Now, when we add a car purchase goal, I did indicate that I wanted my future goals to be inflated, so I'm going to be keeping this data entry into today's dollars for the car purchase goal. We have a couple different options for how we can indicate we are acquiring this vehicle, whether we want to buy a vehicle straight away or straight off the bat, or if we actually are planning on leasing the vehicle or financing. So from the buy or lease dropdown, whatever one we select is going to determine the other parameters that we enter. You can see as we click the different ones, the parameters are going to change. So if we wanted to assume that they're going to be financing this new car that they're purchasing, let's say they're going to be purchasing one of their dream cars, it's going to be $32,000, and this is going to occur in a couple of years. This is going to be occurring in 2027. And then we can assign the ownership, whether it's owned by the client, the co-client, or jointly owned. And then let's title this for our ease. Maybe we want to put the car name. Maybe this is our dream goal of our dream car. Let's just call this the joint family car. And we also can indicate a frequency for this goal. So especially for car purchases, and maybe especially if we have a client that is an avid car collector, if that's the case, the frequency of the goal might be a little bit more often than others. But for the average family, not unusual for there to be multiple cars passing through or acquiring new cars, especially for those that might be leasing cars. We can also assign that frequency as needed. But let's just assume that we are going to be purchasing a new car every 10 years. Until Lorelai's age, I would say 80. So whatever it is, we can kind of define from here. We can define the goal ends at a different calendar year, after a number of years, specific age, or a life event. So let's say this goal starts 2027 and is spanning until Lorelai's age 80. And then down below is where we indicate the expected financing parameters. So we're going to indicate the down payment for this financed goal. It's going to be 20%, the term, and also the interest rate we want to assume. And then we also can indicate how we want this to be increasing, whether it's tied to our general inflation figure, which is 2.5% for myself. If I wanted to tie this to health inflation, which is 5%, and education inflation is also 5%. If we wanted to consider no inflation, or if we wanted to indicate customized inflation. So we can tie that inflation figure from here. And let's just say this is going to be customized inflation, and I want it to be a nice 1.5%. Whatever it is, we can assign from here and hit save. So now that we added that, we're going to see that this is now reflected within the goals timeline. So if we scroll down to 2027, we're going to see the car purchase is happening then. And as we scroll further down, we're going to see that that's happening here as well later on in their life. So they're only purchasing 3 cars across their lifetime, which is perfect for this family. This is what we are expecting to see. So now that we've captured what's happening with the current plan, now we can start to look at some of the analysis side, but also making our proposed strategies, which we could accomplish by navigating to the retirement module. So under retirement, this is where we access our retirement analysis section. This is where we are greeted with the first gauge of financial well-being, which is looking at the probability success, which is stemming from the Monte Carlo simulations, which are 1,000 trials of market volatility. And it's the percentage of those plans that make it to the end of plan without running out of money. So right now for current plan, it's 94% probability success, which is fantastic. But as we just talked about, there's a lot of different factors that we wanted to capture in a proposed plan. So to start to do so, that is when we navigate down into the action items. In the action items, we'll see a couple things populated for us to allow for us to start to propose changes to those existing items. But if there's anything we're looking to modify when it comes to an item that's not already in the action items for us or propose new items, that's when you click on the edit button. But you'll notice that a couple things are already populated here for us, like that existing asset sale of the business being sold in 2028. So whenever we are looking at potentially that business aspect, we can also modify when we plan on selling Lorelai's business. But scrolling down into the edit button, this will open up a screen that allows for us to add or remove either existing action items by checking them off, or if we wanted to propose a new path entirely, and we are going to be doing so, we're first going to be looking at the idea of the family achieving their dream of downsizing when they retire and moving out of state. When that's the case, that's when we click on the Add New Items button. From here, we'd go to the Goals section, and then we'd navigate to the Property section, and then Primary Home Relocation. With the primary home relocation card, this is where we carve out what is happening in terms of what we're doing with the existing property, but also how are we acquiring the new property. So for new home from this drop down, the default is buy a new home. But if we're actually inheriting a property, we can select that as well and then enter the parameters. If we are renting a home, we can also modify that from here as well. And if we're moving into an existing property, we can then make that selection and then choose which property we are moving into. In this case, they are purchasing a new home. They're downsizing when they retire, so we're going to keep that selected. And then we indicate the purchase price for this property. So in this case, we're going to assume it's $375 or $375,000. And then we indicate the location. Now, this is a very important designation because what we indicate here is going to be considered their state location for residency. Since we're indicating somebody is moving from their existing primary home and moving into the property we are detailing here, it's going to consider that they're also moving there and are going to be capturing that state tax calculation. So right now, the family is living in Massachusetts. That's where their current property is. They're going to be moving to a different state. And that's going to be an important designation because we want to make sure we're accurately capturing that state taxes calculations. So especially for moving to a state like Washington, which is also going to be important when we're looking at estate planning, that's going to be an important designation we want to make sure we're selecting from here. And then from here, we'd also specify when we expect for this goal to occur. So we can use the default of this calendar year entry, but from this dropdown, we can indicate that this is never occurring, or we can have it be tied to a life event like Lorelai's retirement or end of plan for one of the clients or co-clients. This case, we're tying it to Lorelai's retirement. We would also enter the other parameters for the property, like annual appreciation percentage, annual property tax, annual tax increase percentage, annual insurance that we want to enter as well, annual maintenance. And then most importantly, you'll notice that when we're purchasing new assets, we can also specify how we plan on paying for that asset. So if we plan on actually just paying for this cost 100% upfront, especially because we're going to be selling that other property at this time, we can just indicate a down payment of 100%. But if we actually plan on financing this cost, taking out a mortgage to pay for this property, that's when we need to indicate the down payment of whatever it is. In this case, it's 20%, the loan term, and then the interest rate as well. So we'll assume it's a 7% for this instance. And then similar to other loan entries, you can also indicate if there's going to be a planned lump sum payoff for the debt that they're taking on for taking this property on. So for the mortgage, if they plan on only carrying this for maybe 10 years and then paying it off at that time, we can indicate that from the drop down. This case, though, we're going to assume that there's no early payoff. So we're going to leave that selected. Down below is where we indicate what is happening with the existing primary home. So since we're moving out of the existing primary home, we can indicate what we plan on doing that, whether we are planning on converting it into a rental home and earning some passive income off of it. We could select that option, and then you would see the parameters pop up for us to start to carve out what we're seeing in terms of income from that property. But if we're actually planning on converting it to a vacation home, we can select that option and then indicate when we plan on selling that vacation home eventually. But in this case, they do plan on selling the primary home when the goal occurs. So we're going to keep that selected and we're going to hit save. And then once we hit save, we are going to see how that's going to impact the rest of the plan. So scrolling back up, we're going to see how that's going to impact that probability of success. Now it's increased to 99% probability of success, which is great. One thing I want to note is the green bar chart is going to be looking at the median trials ending asset value for those 1,000 trials of market volatility or the Monte Carlo simulations, just for reference. That really serves as a benchmarker to see where the trials end up. So already increased probability of success, so that's fantastic. Now, the next question, and probably one of the most popular strategies when it comes to selling an asset, but especially when we're selling a property or the primary home, is commonly to reinvest the proceeds of that sale. Now, especially because that's such a popular idea, whichever planning methodology we have selected, we will automatically be reinvesting the proceeds of that sale. But I want to highlight that if we're wanting to see and confirm that it is being reinvested, where we can go to confirm that information. So we're going to navigate to the retirement module still, staying in the section, and we're going to click into the cash flows. Cash flows being that secondary gauge of financial well-being that provides us a lot of different detailed insights regarding what is happening with the client's cash flows. So this is looking at a straight line projection, which means it's a guaranteed return each year and is not factoring in volatility to the baseline. You have different sequences of return that you want to apply. You can do that with a certain setting, but in this case, we're just assuming baseline. So I want to navigate to the summary section. Now, a very important thing I want to highlight straight off the bat is we want to make sure we're looking at the proper plan here. Right now, I'm looking at the current plan. So I want to actually toggle to proposed plan so I can see what is happening with the property I just proposed. So that was only impacting our proposed plan. So we're going to toggle to that really quickly. And that's going to bring us to the unique cash flows for that proposed plan. So now in the proposed plan, we can see what is happening with the client's cash inflows and the cash outflows in the summary. So this is where we can see that breakdown. We can also drill down into the column headers to see the additional information as well. So this is a very important space for us to see some of those additional pieces of information regarding the client's lifespan, some of those key insights we want to keep in mind when it comes to what is happening with that year-by-year breakdown. Like I said, we can get some additional key insights by just toggling or drilling down into the column headers. So first thing I want to highlight, we're going to scroll a little bit further down. We're going to see for 2037, that's when Lorelei retires, that goal is kicking in. So we're going to see other inflows from here. We click into the column headers. We can click into sale of real estate. We can see that this is the proceeds of primary home being sold. And that's $1.2 million. They have a pretty nicely evaluated home right now. Now, what do we do with those proceeds? The first thing that's going to occur is any inflows that we have in the cash flows are automatically going to first fund our cash outflows. So if they have very high outflows and we don't have any surplus cash flows, it's going to be spent entirely on whatever those expenses are, including the goals and including if we indicated we're fully paying for the cost of the new home in this year. But as you can see, look into the goals section real quick, we can see that property purchase, the down payment's only $100,000 roughly in 2037. So we do have a surplus cash flow. So we see a positive net flow at the end of the year. So what happens is it's automatically invested into the taxable bucket for us. And if we go to the accounts tab, we can also see this activity in the addition to the accounts within this section. So under accounts, this is where we can see the ending balance by accounts broken down by year of the cash flows. But if we use this toggle, we can also view either additions to accounts or net cash flows. So both can show us that kind of addition to the account when it occurs. In 2037, that's going into the taxable bucket. We click into the column header, that's proving that it's going to the taxable brokerage investment. And that's going to be allocated based off of however we have specified the asset allocation, whether it's in the current plan based off of that asset allocation, or if we proposed an alternative asset allocation, it's going to be allocated based off of that. But one thing I want to highlight when it comes to specifically the assumptions when it comes to us selling the primary home. So some of the assumptions that is going to be important that we already kind of addressed was that idea of us inflating figures. So when we're looking at our assumptions, we kind of covered that already, but there are a couple other key things that's going to be important that we can also specify as well. And so that's going to be something that we would address by navigating to the gear icon in the upper right-hand corner. So when you go to the gear icon in the upper right-hand corner and into settings, this is where we can access our other assumptions. So gear icon, settings, other assumptions. And this is where we specify on the client specific level if we wanted to make a unique change for their plan for these assumptions. Now we can also address this in the advisor portal like we did earlier, but this is also where we go to make a unique addressment if needed. So especially if we know for a specific client that some of these costs are different for them, we can make that adjustment from here. So what's going to be relevant for us selling real estate property is going to be our miscellaneous assumptions, because this is where we address the cost of purchasing real estate property that we want to assume and the cost of selling real estate property. So this is where we specify, and that's typically referencing those appraisal costs associated with the sale or purchase of an asset like a property, or some of those closing costs as well. So whichever one we wanted to specify from here, we can make that modification. Now for cost of selling a real estate property, my assumption is that's going to be a 6% cost. But if we know maybe this client is like a real estate broker, so they're going to have different costs than the average client that's not a real estate broker, or if we have somebody that's going to be in a little bit of a different circumstance, we can make that adjustment by just toggling down to customize assumptions for this specification and then modifying this. So let's say for them, the cost of selling real estate property is actually going to be a little bit higher. We can specify that from here. And then we can do the same thing for cost of purchasing a real estate property. So we can toggle down to customize assumptions if needed and make that adjustment. So let's say it's a 0% adjustment and hit save. Now, when we make a specification from here and toggle to customized assumptions, we are only impacting the client plan that we are currently in. So we're only impacting the Gilmore family. This is not going to adjust any other client settings. The only time we're going to adjust all client settings would be when we adjust our global level assumptions in the advisor portal within that other assumptions tab. So now we've made the modification. It's going to look a little bit different when we navigate back into the retirement module. Under cash flows. And then when we go to summary and then scroll a little bit further down, we're going to see the numbers have changed just a little bit for the inflow and also for the goal itself. So that's just going to be an important thing to note for client specific assumptions. We can adjust accordingly because as we know, each client has specific unique parameters that we want to make sure we're accommodating as needed. Now, if we go to back to retirement analysis, we do have a couple other proposals we wanted to indicate. So back under retirement analysis, let's say we wanted to take a different approach, and this is going to be our second branching of the story for the client. They have a different path that we wanted to also evaluate at the same time. So basically what we're saying here is when we are ready to create another proposed plan, we can do so by clicking on the pencil icon next to current plan. That's going to open up a drawer that allows for us to either add a new plan or customize an existing title of a proposed strategy. When we are looking at adding a new proposed plan, we have two different options in front of us. The first one is just click on add new plan. When we select this option, this is essentially going to be copying the current plan and allowing us to build from there. But if we've already started to carve out a proposed plan and we're wanting to build off of that strategy, that's when you click on the copy button for that particular proposed plan. We will then see that populate as just a copy of that one. We can click on the header. And so let's say this is downsizing plus new business. So you can make that title change, hit the check mark, and then hit OK. So now that we've just added that new proposed strategy, we will see the ability for us to use this drop down from here and allow for us to toggle to downsizing plus new business. And this is going to be an important selection because whichever plan we have selected on the left-hand side is going to be the one that we are modifying when we are changing the action items down below to some of these existing action items. So right now we have downsizing plus new business selected on the left-hand side. And so we will see that I do have that primary home relocation proposed here. So that's going to be included because I had checked off that I'm copying the proposed plan and building from there. But we do want to also propose that they purchase a new business after Lorelei sells this one. So we're going to click on the edit button. We're going to click on add new items. And we're going to be adding a goal, of course. And then from here, we can go to asset purchases. So we have two different types of asset purchases we can propose. We have the business purchase, which is what we're going to do. But we also have a lifestyle asset purchase. This is typically used to model things like purchasing a boat or fine art or jewelry. Some of those tangible assets, those are just the lifestyle asset purchases, essentially. This case, though, we're purchasing a business. So we're going to select business. And then from here, we would enter the parameters for that business entry. So let's say this is going to be business number 2 or 2.0. We would then indicate the purchase price of this business. Let's say this is just going to be a minor investment, $200,000, compared, of course, to the current business she owns. We would then select the owner, whether it's jointly owned by the client or co-client. And then we'd select the business type, whether it's an LLC, a partnership, an S Corp, or a C Corp. In this case, it's an LLC. We then indicate when this is going to occur. So let's say that this is going to happen in 2029. We can indicate that from here, and that's a year after the other business gets sold. We can change this from calendar year to a specific age if desired, or have it occur never. And then we can also specify annual appreciation or for the valuation of the company. Let's say it's going to be 15% for them. And then we can also specify the annual income and annual distribution, if relevant, off of this business. Now you will see some info marks that describe to you what the difference is between these two entries. And it's a very important distinction to note because one captures the tax purposes of this income stream and the other captures the cash inflows. So annual distribution will be the one that we are reflecting in cash inflows, but it's not going to be included in the taxes unless we also put it as annual income. So annual income is where we indicate for the tax calculations in the system. We have very comprehensive tax calculations in RightCapital. What we are seeing for tax exposure or for that taxable income stemming from the business. And then if we have that money also impacting the client's cash flows that we want to see coming in each year, we'd specify that in annual distributions as well. Now, most cases, these would be the same number, but in the instance where our tax liability for the income stream off the business differs from the actual cash inflow we are receiving for the client, we can control that from here. But let's assume that this is just going to be a little bit more of a distribution that she currently receives from her other business. And that's going to be $20,000. We can also account for income growth. In this case, it's 6%. We can also check off this is a service income qualified business. We can also indicate if we are going to be financing this business purchase. So if that's the case, we can make that adjustment from here. This case, though, we're going to indicate that we're paying for this cost 100% upfront when we do purchase this. And then we can also indicate what we plan on doing with this business if we plan on selling it at any point, whether it's towards the end of life or maybe we're passing it on. This case, they're going to be selling it after a couple years, though. So we're going to toggle to after a number of years, indicate 5. We'd also indicate the cost of sale we want to assume for this sale of the asset. And then we'd indicate what we want to see for the sale proceeds, whether this is going to be a one-time lump sum payment or if this is going to be a number of payments over a couple years. So we're going to hit save, and then we're going to see how that's going to impact that property success. And one thing I want to note that when we have any asset sale and we have any leftover proceeds, whether it's from a business sale that we have going on already or in the future, and property sales as well, any leftover proceeds at the end of the year are automatically going to be reinvested. So that applies for all those different types of assets. Same thing for us selling a car. Those assets being sold are automatically going to be assumed to be reinvested. So now we can see that property success is 100% property success, which is fantastic. And that models that other situation that we want to evaluate of the different business decisions we can make here. So we can have those two different paths going on at the same time versus the current plan. Now, I want to highlight some of the key visuals before I dive into questions, because I see there's a couple specific situations people want to see modeled. So I'm going to do that as well. Before we do, I want to highlight some of the key visuals we can find here and also some of the different assumptions that can impact your saving specifications as well. But for here, under probability, we can see that juxtaposition of the probability success between the two plans we have selected currently. Now we can toggle to our other proposed plan. So if we were trying to show the juxtaposition between proposed plan 1 and proposed plan 2, we can make that selection from here. Another very helpful comparisons visualization tab is going to be the aptly named comparisons tab. Under comparisons, we can see what is the difference between the two plans we have currently selected in terms of invested assets. So here we can see with our proposed plan 2.0, the downsizing plus a new business has $5 million more in ending assets than current plan. We can also see the comparison between the net worth over time and also taxes. So especially when we're looking at things like selling assets, that can also incur things like capital gains. That can increase our tax burden. So we can see that it is obviously increasing our tax burdens over time. But we can see how that's impacting that specific figure from here. We can also see what's happening at assets at retirement from here as well. So this is going to be some of those key comparison visualizations. Once again, if we're looking to dive into some of the details of any of those asset purchases or asset sales, going into cash flows, making sure we're selecting the proper one we want to see, going to downsizing a new business, for example. Now we will also just see the maps visual. This is going to be highlighting a specific year. So if we're looking to see where our income's coming from in the green and where it's flowing into, we can see that easy to digest visual from here and toggle to different years within this slider if desired. But we're going to be drilling down into the summary, and then we can see what's happening with other inflows. You can see we have the 2 sales of businesses at different years, 2028 and 2034 as well. And then we can also see our goals. So we can see the car purchase because we're financing, we're seeing a couple payments over time. We have the other asset purchase as well for business 2.0 and 2029. And then we also have our property purchase occurring. And then we can see at the end of the year what's happening with positive net flows. When we do have an other inflow stemming from this, the proceeds of a sale of an asset, it's automatically invested. So we have a couple, almost $1.4 million being reinvested over these 2 years. And this is going to be a specification that I wanted to dive into next, because see, there's already a couple questions about this. So when we're seeing my specific cash flows, I'm using modified cash flow based, which means that any surplus cash flows are automatically spent off unless specified otherwise. So this allows for us to control a little bit further the savings. But one thing that's going to stay the same, whether we have this setting selected versus a different one, is that these proceeds are automatically reinvested for us into the taxable bucket. So that's already taken care of. But the setting that I'm referring to that I see a couple of you have pointed out, it's going to be found under the gear icon, settings section, and under methodology. This is where you define for this client plan what we want to run with for planning methodology. So right now, like I said, I'm using modified cash flow based. This is going to be considering that comprehensive financial planning approach, but it assumes that at the end of the year, that any surplus cash flows are automatically spent off unless we capture that with a savings card. So this allows for us to further control what we are saving, still keeping in mind that those proceeds of any sales of assets are automatically reinvested for us. So we don't need to control that specific savings, but other year savings, if we wanted to, we can add those cards as needed. And that's compared to the other option, which is cash flow based. Cash flow based still has that comprehensive approach, but that difference is that at the end of the year, any surplus cash flows are going to be automatically saved into the taxable bucket. So we're saving every single dollar at the end of the year into the taxable bucket. So those are the 2 options. I wanted to highlight that even if you have modified cash flow base selected, you don't need to add another savings card. You certainly can if you want to, but that's already going to be captured when we have those sales of assets. So it's all taken care of for you, essentially. Saves you some data entry as well.